Good afternoon. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective channel, where I help you make your dreams a reality. If you've seen any of my previous videos, you know it. You know that I love strategy. You know I make errors when I make these videos, but you know that I love strategy and targeted strategy. And that awareness is key because I'm going to keep sifting through these financial memes and emails and everything else, using our investment strategies along with some everyday down-to-earth common sense. So this is an unedited video. Who knows what you'll hear in the background as I film these in my house. I have no plans to show our closed-end fund strategy, although I am going to reference it. And that I am not a financial advisor. I am a financial strategist. So please know that I'm not out to slander anybody as I make these videos. Today I'm going to pick on somebody, but it's not my purpose, not my goal to slander anybody. I'm interested in separating the good from the bad when it comes to financial advice because none of us want bad advice as we navigate our finances. So we are still operating. I probably should make this a little bit bigger. We are still operating off my Pinterest board. Let me share my screen. I have a ton of tabs up right now because they do relate to this. We are on this board, and towards the bottom, we will find this meme. I always hear stuff about Vanguard, always, but it does not compare to the closed-end fund market space. One, and I operate in closed-end funds, not single stocks. This is an index or almost like a mutual fund, and there's not a lot of information in the meme. Now, yes, this is my opinion. You'll waste your money. But I wanted to really try to sift through explaining this meme because there's really not a lot of information. Buy and hold, grow your portfolio to $1 million in 10 years if you just invest $1,000. And then you split it between these three funds, and then you get their internal bonus by getting free trades. So what does that actually look like? How is that even feasible? How can you grow 100,000 or how can you grow $1,000 into $1 million in 10 years? That makes no sense. I mean, even in the world of compounding interest, like that makes no sense. So it's perplexing to me. So you can find retirement calculators several places online. I generally go with NerdWallet. And no, that's not an affiliate thing. It's just I just go with NerdWallet. So if we look at their claim, so I'm 44, I make about 80 grand a year, and I picked this number because that's what we have initially in our Roth. Now, that being said, this relates to their meme and it doesn't. So this number relates to what started our Roth. But that's not what the meme said. The meme said 1,000. So with $1,000 invested, 10 years, 54, I actually looked at their average rate of return for this one fund for the last several years. So these were the returns based on this data. Put them into a spreadsheet, and we get a general average of about 10%. Some years it's better, some years it's not. So where are we? Come over here. So we get 10%. Rest of this doesn't exactly matter. So let's change this number until it hits 1 million. Let's close. That's really close. Perfect. Now, if you invested $1,000 off the bat into three general, which we'll go back. So there's three funds listed. I just looked at one. that has a 10% annual return over the last 10 years, 2014, 2015, so the last 9 years. Uh, and it, if you invest this much, you could hit $1 million. Now, what's the return? Investopedia says it best. So the return accounts for everything. You're looking for gains of interest, dividends, any kind of share price increases. So it's all the gains you experience for one company versus dividends are just the dividends. Now, you're essentially calculating return in hindsight, and it's hard to project return. I think a much safer way, maybe more effective way, is to look at dividends. Uh, but for this meme, using the average metrics over the last 9 years and applying that to their claim to grow your portfolio to $1 million in 10 years, you would have to invest $4,656 a month in order to hit $1 million in 10 years. That's crazy. I mean, there are people scrounging for that to invest a year, not alone a month. So that's illogical to me. So this is a Roth calculator. Here's the interesting thing. So, or maybe the more interesting thing, most investment agencies, Vanguard, Morgan Stanley, JP Morgan, throw a name out there. Most people still go off this 4% rule, meaning every year you're retired. And I get into this on a lot of other videos. Every year you're retired, you're taking 4% out of your portfolio. So off $1 million, 4% would be 40 grand. You're taking 4% out, hoping that the market generates at least 4% or more so that you break even on the year. Now, here's the problem with that in general. Predicting the market every year is troublesome at best. And if we look at this, you'll see that there are 4% years and not 4% years. There are years that blow the 4% out of the water. But there's no guarantee for that. And you're selling your portfolio overall value at random times. So you can dollar cost your way up. You can also reverse dollar cost your way out. You might have to sell when the market's high, and you don't want to sell then. You might have to sell when the market's low and take a loss. So that's not a great metric. The other is when you retire, are you going to be making 40 grand a year or double that? So if you're used to making 80 grand a year, now you've got to live off 4% or 40 grand. That's not a great system. That's not a great strategy. It does not take into effect taxes. Most retirement accounts, so if it's pre-tax money, like we as teachers, we have a 403b. We have money that's taken out of our paycheck before taxes so that we decrease our taxable income. And we're putting money into this mutual fund system, which I am not a fan of, but such is the game for now. But you're putting money into this mutual fund and all pre-tax money so that when you take it out, it's actually going to be taxed when you take it out and it becomes part of your income. So you're increasing your overall income. So maybe not, you pay a higher income tax percentage. It's also taxed on the way out, so it doesn't help. So When you take out that 4%, it's adding to your income and you're taxed differently. You're also losing 4% of your portfolio value consistently. And maybe at weird times in the market, it maybe you won't gain the 4% back. Plus, it doesn't factor in your overall expenses. It doesn't factor in healthcare, the house, all the other stuff, and it doesn't factor in your spouse's retirement. So it's a very faulty system. I don't like it at all. Our goal is to retire on dividends or supplement a retirement on dividends. Um, in doing that, we don't want to take out the principal. We want to take out the dividends. So our current metric of 9% and our current portfolio generates 12% on dividends. So give you let's say we hit the magic number of $1 million, right? Is now 90 grand a year on dividends. And inside the regular general retirement account, those are still capital gains. They're still taxed. The interesting thing is inside a Roth, they're not taxed. So a Roth account is all post-tax money. Your taxes have already been paid, and then you're putting money into this account. You're limited on how much you can put in. But so long as you jump through the hoops, and I have no idea who's texting me, so long as you jump through the hoops, when you take the money out, you don't pay any taxes. It gets noted on your tax return where the money comes from, but there are no associated taxes. So this looks at the difference between this example of a Roth IRA and a taxable account. So current age, general info, starting balance. Last year in 2023, the maximum for the Roth was 6,500. It went up to 7 grand for 2024. Works out to like 583 and change a month if you do it monthly. You can add it randomly. You could do 3 grand up front and 4 grand at the end. Really doesn't matter when the money comes in. There's also a built-in gray area. So really up into tax day, whatever actual day that is, you will say taxes are due April 15th. So even though it's April 1st of 2024, we could have still put in money into a Roth for 2023. So it gets earmarked 6,500 for 2023. And then you can also put it like you wait a day for it to process, and then, or really it's just 2 different transactions because it gets tagged in whatever system you're using. And then you dump the full amount or whatever amount you want in for this year. And then that's your starting balance. So if you really wanted to, for 2024, you could start with 13.5 and then you build it off of that. So in a Roth, this is our starting balance. If we maxed out the contribution every year, we're doing dividend rate. Now, our goal is mostly buy and hold, but there is going to be some rollover, meaning we have metrics that we look at. So if we see an increase when we sell that stock, that price increase stays inside the Roth. There's no taxes associated so long as we jump through the hoops. So we can roll that money forward into a different investment. So on just the dividend increase alone at 12% right now, lost track of there we go. 12%, I'll be honest, is not the overall rate of return because we just opened the Roth. But if that were the rate, so if we use the dividend amount as a baseline for the projected rate of return, then this is what it looks like. And so long as we jump through the hoops, it's not taxable.
If you do that with a standard account, standard general, like if we base this account on Vanguard's metrics, which this is what you're getting if you get VYM, you're paying 118 a share, almost 3.5% dividend, paid quarterly. So you're below inflation. You're not even equal with inflation. You're losing money every year if you go this route, just on their dividend. Based on what's in their portfolio, it's almost everything. I mean, they've got some allocations in every box. It's a portfolio in a can. It's almost all stock. It actually is. It's all stocks. It's not bonds or private investments. And it's a collection of, it's like the top 30 companies, really. So let's see, return that. So it's the index fund. Like you're getting access to a lot of different funds, but it's also not funds that I want to be in right now. But if you use their stuff in the same time frame, you end up with this amount at the end of that time frame, and all of it's taxed. It's not tax deferred. It's not tax waived, or it is tax deferred. It's not tax waived. You're paying taxes on everything you make. So in general, and then I'll spin it one more time. In general, from our standpoint, closed-end funds in general, this doesn't benefit us. Closed-end funds, we get so much more out of it than the random index of funds. And to hit your portfolio value of $1 million in 10 years, putting in $4,600 a month, that's nuts. So I still suggest that you take on your own investing. You do self-directed wealth management and work on managing your own money. We manage ours in Webull, and I make closed-end fund videos every week. And every time I show our portfolio, that is our portfolio. So you get to see where we succeed, you get to see where we don't succeed, and we collect the dividends regardless. And take this one. If you have not started a retirement account of any sorts, you should, because at some point, if your goal is to play the game and retire at 67 plus, at some point you're going to retire. And if you were like us and you want to retire before then you've got to figure out a way to make that happen. But probably the best thing you can do, in addition to prepare your own retirement, is to prepare your kids' retirement. And so if we still look inside a Roth, I just picked 20. I mean, we could make it whatever age. But if you open a Roth for your kids, it asks you some data. I mean, whether single or other, annual income doesn't matter. You're capped on what you can contribute every year. So if you just start out for 1 year, right? Or maybe you do it in that gray area and all this, and your starting balance ends up being this much. Your goal is to max out the account every year. This is the estimated rate of return based on dividends alone, not on anything else. Then your kid retiring at whatever age, but if they retire at 67, that means that you're starting the process for them, you're modeling the behavior, you're teaching them the value, and you're helping set them up to then make the annual contribution however they want to add it. And currently it's $7,000. Take it by 12, you're putting in 583. You can put in the change, or you're just putting in 583 a month, which is almost $7,000, and then capping, rounding it off at the end. And then showing them the initial value
right? So 12 years out, they're 40 grand ahead. That's not accurate. That 12 years in, they're gaining ground. Now they're gaining more ground, right? And now it's a completely different ballgame. So for you and me, there's still hope that we can plan our retirements well. And for our kids, there's so much promise out there. I can be completely honest when I say that in all my years of school, nobody explained this well. I didn't get taught this in high school. I didn't get taught this in college. I for sure didn't get taught this in grad school. Dave Ramsey mentions this some in his overall financial freedom journeys, but he doesn't really talk about the whole system of a Roth well. Um, and I like Dave Ramsey, but his methodology does not meet our needs as working professionals. It does not meet our needs as teachers. Doesn't encompass the whole teacher retirement system game, and he doesn't teach about owning property, owning investment property. Dave Ramsey invests in investment property, but he teaches people not to go into debt, which is kind of weird. So, but when it comes to the Roth, I think a Roth account long term using closed end funds as your basis is a lot better than this. I mean, I don't have 46,000 or I don't have $4,600 I can invest monthly, 46,000 I can invest annually. Um, as a teacher, 7 grand is hard enough as it is. I can't imagine it. I cannot, I can imagine that level of money, but knowing our budget as I do and knowing the structure of things, I just don't, I can't picture investing that much money every month. It's crazy to me. Um, but I think this style of investing long term is a lot better option than investing in this in general. And there's no, like, this sounds great, but it's not feasible. And if you know of a way this is feasible that's completely opposite of this video, then by all means post it. I would be interested in chatting with you and what what you're saying. I'm not going to write it off as I would not write it off. I would be interested in seeing what you say. But for what I can find, memes wise, online wise, this is not the way to go at all. Uh, I would much rather invest based on the existing market structure and buy the best thing for now with the long game in mind. And uh, these funds are not my style. They don't help us. So that's all I got. If you enjoy the content, then consider subscribing to my channel, hit the like button. And if you want more info on our 12 steps to financial freedom, then go to Facebook and find me there under the navigate your finances page. Um, as you approach your retirement, as you approach your finances, you captain that ship. It will go wherever you direct its course. If you opt to let the boat go wherever it wants, there's no telling where you'll end up, and you may not like it when you get there. If you choose to pilot the boat a little bit and take a really long nap and just not pay attention, you're still not going to get where you want to go. So you really do have to know where you are. You really do have to know where you want to go, and you have to actively steer the boat because those dreams of yours are not going to happen on their own. Even with modern technology, even with modern navigation, right? I set my waypoints, the boat just steers itself. You still get slightly off course with the wind and the waves and the current. Um, that 1 degree of difference may not seem that big of a deal in the immediate, but by the time you get there, you can be really far off course. So captain your boat, take the helm, take the lead,
direct your course, and make your dreams happen because they're not going to happen on their own. Make your dreams happen. So I wish you a great week, and I will see y'all on another video to figure out how to get rid of this one. There we go. How to get out of this one. There we go. So I wish you well, and I will see y'all on another video. Bye-bye.